Off to the races here. Good afternoon, everybody. Thanks for joining us again today. This is our second quarter 2026 market review and outlook webcast. My name is Michael Musio. I'm the president of FBB Capital Partners, and I'm joined, as always, by my colleague Michael Bailey, who is the director of research and chair of the investment committee here at FBB Capital. And as always, working behind the scenes with the technologies, our teammate Katie Bogley. So thanks all for joining. Today, we're going to review all that's happened in Q2 and look ahead to the second half of the year. We'll then have an opportunity for some Q&A that will address previously submitted questions and allow for live questions on the fly. Quick housekeeping item on that. If you look at the bottom of your Zoom screen, there's a series of it says like raise hand, share. It may say Q&A. If you don't see a Q&A button on that bottom row of activities, click the More button, which should have a few dots, and you should see a Q&A box pop up there. So feel free on the fly as we're going through the prepared remarks, type in a question. I'll see it come up. I'm going to do my best to take similar questions and combine them in one question or a couple questions so we can move through and try to get through everybody's questions as we go along. When I do that, if I've got a name, I'll give a first name. Claire asks, for example, and we'll do our best to go through it. Finally, we'll be recording the call today, which will be posted for replay on our website, probably by tomorrow. That recording has begun at the top of the presentation here. And as we get started, let me please remind you the fact that today's commentary is based on the facts as we see them today, which of course, particularly in these markets and these times, are ever changing. Please note that any reproduction or transcription of statements made during the call without our approval is prohibited. Again, it will be posted online. If you know somebody who would like to listen in, you can direct them then there to our website. Please note that all forward-looking statements made during the call are subject to risk and uncertainty that could cause actual results to differ materially from the expectations and assumptions we discuss. Finally, please review our complete compliance statement disclaimer at the end of the webcast. All right. With all that behind us, Mike, I'll turn it over to you for the heavy lifting. Let's get to it.
Great. Thanks, Mike. So today we'll pick up where we left off last quarter with the Iran conflict and review de-escalation and changes in commodity prices. Speaking of prices, we'll then turn to a look at how inflation is impacting monetary policy for the incoming Fed chair. We'll then turn to an update on continued growth in AI and a broader look at investor sentiment. And next, we'll try to put these pieces together as we review our stock and bond positioning. We'll wrap up with your questions. Next slide, please. So in 2026, we've seen two major forces impacting the economy and markets, namely energy and artificial intelligence. This quarter, we're posing the question, is AI the new oil? Mainly because of the rapid changes in geopolitics that have pulled oil prices up and then pushed them back down. However, at the same time, the AI revolution appears to be on track for another year of significant growth. In summary, while energy remains critical for running the economy of today, investors appear to be saying that AI could be running the economy of tomorrow. Today's presentation will lay out some of the implications for the short cycle changes we're seeing in energy markets and the longer cycle evolution in AI in the tech sector. Next slide, please. The security situation in the Middle East has been changing rapidly this year, but many investors expect a general de-escalation to continue, which will likely increase oil supplies, especially through the Strait of Hormuz seen here. And this expectation has driven a downward move in oil prices from a high of nearly $110 a barrel in early April to closer to $70 now. While the worst of the conflict and the spike in oil prices could be behind us, we are keeping an eye on any developments that could reverse the more favorable trends we've seen in recent weeks. Next slide, please. So while oil prices have come down significantly, many parts of the economy and markets are still dealing with the aftermath of these big commodity swings. Starting with the bond market, we've seen fairly big move up in yields for the 10-year Treasury, reflecting a view of the lingering effects of inflation from the Iran conflict. In isolation, we view higher bond yields as attractive. However, elevated inflation reduces some of the attractiveness of these bonds. However, if inflation does fade, which we generally see as likely, then buying and holding bonds at these yields could support additional performance for portfolios. Next slide, please. We just showed the impact of higher oil prices on the bond market. Now let's expand that view to other parts of the economy, including consumers. In general, we're seeing a fairly resilient consumer in the face of higher gas prices, but we are seeing some changes with more spending and less saving, trading down to lower priced goods or buying in bulk, as seen here, and pulling back from some discretionary areas such as restaurants. With oil prices moving down from recent highs, we should see generally steady consumption continue, especially since employment rates remain well above historical averages. Next slide, please. Our next stop on our tour through markets and the economy is the Federal Reserve, where incoming Fed Chair Kevin Warsh is dealing with uncertain and volatile trends right out of the gate. We just mentioned that the job market's in fairly good shape, but the real question mark for Kevin Warsh is on inflation, which has ticked up to about 4%, as seen in the chart on the right. During Warsh's first press conference earlier this month, he kept hitting on the importance of price stability, which many investors are reading as bring down inflation. Markets are predicting about an 80% chance of an interest rate hike by year end, as Warsh tries to clamp down on the lingering effects of the Iran war and the spike in oil prices, which are slowly moving through the economy. The challenge for Warsh will be to slow the economy and reduce inflation without triggering a wave of layoffs and a recession. Next slide. So while the Fed and investors are focusing on short cycle changes in inflation, deep pockets in the tech sector continue to build out a multi-year investment cycle for new AI tools. This chart shows capital spending among the top 4 cloud computing companies, which are the biggest spenders on data centers and semiconductors that are powering AI models, such as ChatGPT, Google Gemini, and Anthropic's Claude. We get frequent questions about what inning we're in with this AI build out, and while it's difficult to know exactly how long the AI expansion will play out, we continue to hear about excess demand for AI tools, along with supply constraints for energy, data center construction, and hardware, suggesting that growth will likely continue for some time. Next slide. So as we pull together some of the investment themes of 2026, we're seeing some stark contrasts. Towards the end of the first quarter, the worsening Iran conflict drove up oil prices and pushed energy stocks well ahead of the broader market. At the same time, a multi-year bull market in AI and tech stocks began to falter as investors took a more risk-off approach during the initial weeks of the Iran conflict. However, we saw a complete reversal in the second quarter as de-escalation in the Middle East drove oil prices and energy shares down, while surging AI demand focused on semiconductors recovered and overtook the energy sector. So while this rapid reversal of fortune might not answer the question, is AI the new oil? It certainly suggests that AI-related stocks will remain an important part of the economy and market for some time. Next slide. So since this section of the presentation is focused on growth in AI, you might wonder why we're showing a picture of a SpaceX rocket. There are a few reasons. First, SpaceX is mostly a rocket and satellite company today, but Elon Musk and team have big plans to put AI data centers in space. We'll see how that works out. Additionally, we are using the SpaceX initial public offering, or IPO, which was the biggest in history, as a gauge of investor sentiment. And with SpaceX shares above the IPO price, it seems to support a broader bull market for equities. Speaking of IPOs and the AI sector, 2 other players out there, Anthropic and OpenAI, may do IPOs later this year, presenting another test for investor sentiment. Next slide, please. So keeping with the theme of investor sentiment, while big flashy IPOs are grabbing headlines, the broader market has been buckling down and generating profit growth across most sectors, both inside and outside of the AI complex. Profits are likely growing in the mid to high teens if we take a 3-year period from calendar 25 to calendar 27, which we see as supportive of the 9% year-to-date return in the broader equity market. To be fair, some of the mega cap tech companies are spending some or all of their earnings on the AI build-out, as we showed in a previous slide. While this takes away cash that could go back to investors in the form of dividends or share buybacks, these mega cap tech companies are betting that investing in AI today will drive future growth. Next slide. So another way to think about the health of the broader market is to look at what kinds of companies are outperforming. Many of the AI-related companies, such as Microsoft, NVIDIA, Amazon, Google, or Alphabet, are in the top 100 of the S&P 500. And while these mega caps are generating reasonable performance, kind of up mid-single digits, we're seeing even better performance for smaller companies, as seen in the S&P 500 Equal Weight Index, where smaller companies move the index just as much as the giants. Our punchline here is that AI continues to drive growth in the US market. However, the S&P is far from a one-trick pony, as smaller companies and non-AI stocks continue to perform well. Next slide. So as we look back on the first half of the year and look ahead to what's next, we continue to favor a fully invested approach across equities and bonds, which make up the majority of most client portfolios. For stocks, we see a fairly constructive outlook as long as three current trends persist, namely, Middle East negotiations continue, Kevin Warsh and the Fed keep inflation under control, and AI-related demand helps to drive profit growth in the mid-teens. Within this framework, we tend to favor US stocks, which are slightly more expensive than international equities, but tend to grow faster. For bonds, we mentioned earlier that rising yields are increasingly attractive. It could be even more favorable if inflation fades. We also continue to favor rebalancing into bonds for portfolios where equities are exceeding allocations. Next slide. In sum, the second quarter brought some favorable developments in terms of reduced Middle East tension and falling oil prices. Although lingering inflation could lead to Fed rate hikes later this year, which could slow the economy somewhat. Additionally, we're seeing continued growth for AI companies and for the rest of the market, supporting year-to-date gains in performance. And once again, some of the surprises we've seen so far this year tend to support a fully invested approach rather than trying to time the market. So with that, we'll wrap up our prepared remarks and turn to your questions. Mike?
Great, thanks, Mike. Yeah, I think that was a good summary of where we've been the first half of the year. Also, a really quick rundown on the prepared remarks, so we have plenty of time to get into some Q&A here. And we've got some questions that kind of go throughout the prepared remarks that have been submitted in advance. To a reminder of those who are on the call who would like to submit a question on the fly, there's a Q&A box at the bottom of should be at the bottom of your Zoom screen. You can click in that, type in a question, and we'll get to it. So let's talk about AI for a minute. So Carol asks, and Carla asked a similar question, which I'm going to kind of combine these. But as you think of like the AI kind of value chain, Mike, can we kind of look at that across the board? You mentioned the Microsofts, the Amazons, and the Googles, and just give us like a quick, rundown of where they are in the value chain versus the chip companies versus the chip manufacturers, and where FBB clients are playing in some of those areas. Just as a reminder for folks would be helpful.
Absolutely. So, AI in the tech sector is just a really big portion of the broader market. It depends how you want to slice and dice it. But in general, for most equity allocations, we are in line or slightly ahead as far as the tech sector weighting, which is pretty meaningful. But to really dig into the food chain here, there are definitely a lot of players. A few of them are private currently. So OpenAI, Anthropic, et cetera, those companies that have AI models, they are private. Google or Alphabet does have a pretty widely used AI model. So many of our clients are participating there. There are certainly other parts of the food chain. So we mentioned the big cloud computing companies, so Google, Amazon, Microsoft. They are building out data centers. Data centers, the highest value portion there are chips, semiconductors. NVIDIA at this point is the biggest semiconductor company. So again, we do own that. Investors are participating in the AI boom through NVIDIA. There are other ways to do that. So NVIDIA designs chips. Taiwan Semi is a company that manufactures those chips. We've been a relatively early investor in Taiwan Semi that has been a big holding for many FBB clients for some time. You can go further back in the food chain, and there are companies such as ASML that they build machines that they sell to Taiwan Semi that manufacture these chips. So there's sort of a whole value chain here, and we are participating throughout. Certainly, additional ways, companies such as Vertiv that are helping with power for some of the data centers, et cetera. So a lot of ways, and I think our approach is to diversify as opposed to just pick one or two companies and hope for the best. So that diversified approach is really the way that we're going as the AI build out continues.
Great, thanks, Mike. Going back to the sentiment slide, which I think is where we had the SpaceX rocket taking off. Marion asks if we would be investing in SpaceX, when and why, and maybe just talk about the capital kind of raise aspect of the IPO, but then what happened, a week later with some debt issuance and just some of the stuff that's going on there, please.
Yeah, absolutely. So I will kind of hit on the client's question initially. Are you investing in SpaceX? At the moment, we are not including SpaceX as a widely held stock for clients. We're certainly evaluating it as a big company, as we would every other company out there. There's certainly a lot of risks. There are risks to every company, but I think for this one, they're certainly somewhat magnified for a lot of different reasons. You could spend a whole hour just talking about it, but certainly there is major execution risk. The company is planning on launching a bigger rocket, launching more developed satellites. A lot of things need to go right for this story to work, which it could. So that's certainly a physical sort of engineering risk that's out there. The other piece is financial risk. So, Mike, you mentioned some the IPO financing, which is massive. So on its own, just the scale of that is something significant. In addition, SpaceX, the company, is doing deals. They're spending billions of dollars, like dozens of billions of dollars, to buy AI companies and tech companies. They're also issuing debt, I think, to the tune of roughly $20 billion dollars a week or so after the equity offering. So we're getting a lot of financial leverage, a lot of financial risk on top of this kind of regular business engineering risk. Worth watching. There's a price for everything, and I think if at some point we view the risk and reward profile to be attractive, we'll certainly look into it a bit more closely and potentially own it. But it does seem, especially compared to many of the stocks that we own, the risks are highly significant there. So certainly worth watching, but having some caution.
Sticking on the IPO front for a minute. So Joy asks if we can explain how the AI IPOs, and that we can include SpaceX in this, I think, because of what's happening in terms of the rules, and how it's going to affect exposure that we may have, broad-based exposure vis-a-vis the indexes writ large, but then maybe some ETF exposure that we have that follow said indexes.
Absolutely. So at this point, SpaceX is the first kind of mega IPO of the year. There are a couple more, kind of following closely. OpenAI, another AI model company, and then Anthropic. So we were talking, just massive, billions and billions of market cap. At the moment, again, only one of these is public, SpaceX. SpaceX is excluded from all the major indices as of now. In a few days, I think July 7th, perhaps, the NASDAQ 100, largest stocks, the NASDAQ, will be including SpaceX. They're kind of speeding up their rules and cutting some corners to include it. So that there's that. Many FBB clients do not own that as a widely held ETF. Another ETF, S&P 500, there's certainly different ETFs that own that. Again, at the moment, do not own SpaceX or any of these other big IPOs. The S&P 500 is saying that it is unlikely to include SpaceX for some time. It sounds like several quarters, maybe a year plus. So again, at the moment, most FBB clients are unlikely to own SpaceX, even in a broad-based market ETF for some time. There certainly are ways of getting access to it, whether it's going to be NASDAQ 100, et cetera, for folks that want that. But again, at the moment, less exposure. The other AI companies, OpenAI and Anthropic, I think most likely the same thing. So less likely to see those in the S&P 500 right away. Could be at some point, within a year or so. And we'll certainly evaluate the pros and cons of the new S&P 500 if and when these new IPOs get added.
Very good. Thanks, Mike. Marilyn asked a question that's comes up a lot when we're having client meetings. In fact, came up in a client meeting or two yesterday and today. So there seems to be this bit of a disconnect to most people, I would say, in terms of the degree of political and economic instability, and specifically, how it is affecting people. We've talked about the K-shaped economy in terms of people on the upper arm of the K and the lower arm, and specifically on the lower arm, how it's affecting people with fixed incomes and in terms of stubbornly high inflation that's spanned a couple administrations and seems to be on a little bit of an uptick here. You had a chart on that, Mike. So just maybe the bifurcation of the markets and an overall back to sentiment, really, sentiment feeling of not great and by some standards not adequate, and what that looks like and what drivers might be there.
Yeah, certainly a very wide open question. We can probably spend a whole hour just digging into all the parts of that. A few ways to tackle it. I think yes, as a if we were to step back and take off my investing hat, just American citizen hat, it does seem like looking at the news, looking at the media, there's a lot of uncertainty, whether it's political, geopolitics, security, Middle East, commodity prices. A lot of things are changing, and a lot of surprises, and many of them not favorable. So that's certainly something that's impacting all of us, day to day. I think the question is putting that in perspective. How does the uncertainty we're feeling now compare to, kind of general uncertainty we feel throughout history? And then we can try to measure that in a couple different ways. You can look at the stock market. So the stock market's done fairly well this year. Bond market yields have come up a little bit, reflecting a little bit of stress with inflation, but not massively. There's some other things you can look at. Again, just stick with some financial metrics, we'll look at some others, but there's the VIX or fear index, something where you can look at how rapidly the market's moving around. It's been relatively tame. So that you can go on SpaceX IPO, a lot of investors are bullish about that. So from certain sort of a financial angle, maybe even an economic angle, employment's in pretty good shape. You could argue the uncertainty we're feeling is maybe not reflected in some of the numbers. We can pivot. We showed a slide at a Costco. Consumers are changing a little bit. So folks are digging into savings. They are continuing to spend. They're pushing that savings to buy gas at the pump. That's not a lot of fun. That means by doing that, you're not doing something else. That also means, I think, to the point on the K-shaped economy, folks where paying for gas for your car, that's a big portion of your budget. That's really squeezing that income cohort, maybe less so at the top income bracket. So a lot of changes happening kind of under the surface, but big picture, we're really not seeing a massive, kind of new risk factor emerge in markets at the moment. So great question. I'm sure we'll be coming to back to that in future webinars.
All right, very good. Switching gears a little bit, Claire asked the question, uh, any thoughts about renewable energy sector? Current administration doesn't seem to be promoting it, but war and rain gives it a boost, as might energy demands of AI data centers.
Yeah, great question. I think for us, the renewable energy sector, we've seen some volatility in that sector over time. The one way that we've chosen to have some exposure there is through electric utilities, in particular ones that are building solar, building wind power generation, et cetera. So NextEra is really the major exposure there. Historically, they've grown faster than most other utilities, and so we feel like that's a way to kind of own renewable energy, but also not make a really highly focused bet that can really show some significant volatility. Certainly other ways of playing that. We're always evaluating ways of doing that. The only other angle that's not necessarily renewable energy, but certainly energy and power related to the AI build out is Vertiv. So that's an industrial stock that we own that's really been growing pretty significantly. And there's been as I mentioned, sort of a supply constraint for these data centers. One of those supply constraints is energy, basically any type of energy source, and then all the physical hardware that goes to build out the energy that's powering these data centers.
Great. Thanks, Mike. Um, I've got another one here that I'll take this one, Mike. But as I'm doing that or teeing that up as a reminder to folks, feel free to click on the Q&A there on the bottom. If something comes to mind, let us know. Susan asked about specifically about the different types of retirement withdrawal strategies that are available to retirees and specifically through FBB. And I'll semi punt on this one that it depends on your individual circumstance, Susan. But I encourage you to talk to your portfolio manager, your lead advisor about what type of withdrawal strategy makes the most sense for you. One thing I'll say for everybody's benefit, I think that where tax rates and brackets are these days and different kind of scaling and levels of income as people are required to take money out of their retirement accounts or via requirement of distributions and Social Security income and these types of things. The premise of brackets or tax rates being lower in retirement than when folks worked is not exactly uh, uh, playing out the way that the architects of these structures thought they might 50 years ago. So It does mean that on occasion you're taking, or part of our distribution strategy for clients is taking some money out of retirement accounts before minimum distributions are required. And again, that's going to depend on the entirety of your balance sheet, how much money you have in Roth IRAs versus regular retirement accounts versus after-tax investments, all these types of things. So again, for more detail there, and even some modeling, obviously, to get back in touch with your advisor. Okay, very good. I don't see any other active questions. I guess I have a question. I don't know if we have a chart to it, Mike, but we talked about bonds for a minute. We talked about the kind of spike up in yields um, as the U.S. went into Iran, and those yields in the 10-year have come back down, but still in the 435 to 440-ish area. Maybe just in terms of like a recent historical perspective, give some background to folks on that for us.
Yeah, absolutely. And Katie, if we could turn to, I think it's the last slide in the presentation. I think it's slide 21, I believe. Um, See if we can get that. Let's see, it should be one more. Yeah, perfect. So yeah, this is definitely something we look at. Earlier we showed a short-term look at the 10-year Treasury yield, kind of yield on a one-year basis. I can't really appreciate the major changes we've seen over the past decade. So again, short-term yields are starting to come in. Typically, Treasury bond yields reflect growth and or inflation. So if inflation moves up, a lot of times bond yields are also moving up. We saw that happen this year. Iran conflict, oil prices up, inflation up, bond yields up. Let's zoom out again to a prior decade view and what happened. So, kind of going back pre-COVID, bond yields were sort of modest in the low single digits. Getting into COVID, basically many investors panicked about just a massive slowdown in the economy, which we saw quickly. Growth came down and rates came down. Very quickly, though, again, this may bring up some bad memories for folks. Coming out of COVID, there was this massive demand for stuff and purchasing goods. And so massive demand, there's some supply constraints coming out of COVID. This led to massive inflation really across the world. And so inflation up, bond yields came up very, very quickly. Again, this feeds into housing, mortgage yield, mortgage costs are up, et cetera. So we're still in this era, kind of this post-COVID, post-supply supply chain stress era, and yields are kind of in the closer to mid-single digits. If we were to zoom out even further, throughout most of history, this is closer to average, kind of mid fours and fives. So that's kind of where we are. So if you put that in perspective, the past year, things aren't really moving that much, which in some cases is probably fine. Again, if we go back to calendar 22, that was the steepest move up in this curve. When bond yields go up, bond prices go down. And that was a very difficult period, I think, for any investor that owned either stocks or bonds. We had an equity bear market and we had a bond bear market at the same time, which basically never happens. So that would be kind of the worst outcome, would be for some massive inflation. Again, cut me off, Mike, if I'm going too far, but I think, if, for example, the Iran conflict went further, the Strait of Hormuz were to be closed for months or years, I would expect oil to keep running, inflation to keep running, and bond yields were likely to keep running. So it all kind of feeds back into an interconnected sort of system here, but a little bit of perspective in terms of where yields are.
Yeah, thank you. And I would just add to that, if you see that initial spike that looks like a check mark right by the arrow that says supply chain stress, inflation, and rate hikes, if you look down below at the timeline, that kind of check mark shoots up to the mid to third quarter of 2022. And that was when inflation, peaked out, right? We hit a 9%, a nine handle on CPI. CPI is less than half of that now, and the 10-year Treasury, which is the benchmark Treasury or benchmark rate for basically everything, is valued with this as a starting point, and certainly in the bond market. And fast forward, basically 4 years. I think it was actually June of 22 was the peak on inflation. Inflation is less than half of that. It was down by about two-thirds. And the 10-year is actually still a little bit higher than it was back then. And so for clients, who aren't fully invested or fully embracing the fixed income part of the portfolio. A lot of that is some brain damage attached to the pre-2022 when we were getting 1-2% kind of yields, maybe 3% on a 10-year for years and years and years. If Mike extended this chart out to 2009, basically since the Great Recession, it would look a lot like the beginning of the chart versus the end of the chart. So the point is, there's still some opportunities in the fixed income market for sure. In some regards, the fixed income market is cheaper than the equity market. If the 10-year bench is at 10.4, then you're able to still get 5% plus in corporates. If inflation is 3 or 4%, you're still getting a fairly respectable real yield. When inflation was 9%, it was a negative real yield, which is pretty terrible. But that was a good time to start buying bonds and diversifying it at higher rates of interest. And then the one last thing I would say on this, we're looking at the 10-year. Keep in mind here that about that 2022 timeframe, that's when rates were going up. And then mid to late 23, rates started going down in terms of short-term rates. And there's been several rate cuts, but the 10-year has stayed, as you can see to the right side here, pretty dramatically and kind of methodically between 4 and 4.5%. And part of that is, I believe, market and market participants and investors, particularly in the longer end, recognizing that U.S. credit quality is perhaps not what it was, even 5 years ago, because our indebtedness has gone up. So that's a story for another day, but I think the opportunity there in terms of the yield is still something folks should pay attention to. So
Maybe Mike, just add one other sort of
yeah,
comment. The one other piece, which is not in the notes, early calendar 22 was the beginning of the Ukraine war. So certainly that issue
correct.
pulled a lot of supply off the market. We saw another wave of commodity prices moving up that also added to inflation. So you had the supply chain issue as well as that. Again, in calendar 26, we've only seen the energy portion of that, which has reversed mostly. But certainly when you get one or two or three factors coming together, that can really move inflation up. It really impacts the bond market. So we continue to keep an eye open for that.
Yeah, great. Well, very good. That's all the questions we have today. Thanks everybody for tuning in. First half is in the books here in about 30 minutes time. The markets will close and we'll be heading into July and the second half of the year. Should you have any additional questions or anything specific to your portfolio and or your financial plan, please reach out to your portfolio manager directly. They'd be happy to help. Thank you for joining us. Have a happy and healthy 4th of July and happy 250th to the good old US of A. So thank you. Take care.